Gold and silver will be the benefactor of this. And when you see the amount of huge money over the last 8, 16, 17 months that has stood for delivery, that's all you need to see. They're positioning, and they're continuing to do so. And if it's that important for the governments to do so, they won't make it easy for the rest of us. The volatility, the counterintuitive rhetoric, all of this stuff, that's all part of what they've done forever. And as the stakes get higher, so too will the volatility, and the ability for those to hang on will be less and less and less. Don't let go. Don't sell your metal. That's all I can tell you is that this is not over, not even close. This is the volatility one would expect in a shift like this. Big money, big stakes, big volatility.
In today's turbulent financial landscape, precious metals are regaining center stage. According to Andy Schectman of Miles Franklin, unprecedented physical delivery demand over the past 16-17 months signals strategic positioning by major players. Governments and institutions appear to be accumulating gold and silver quietly, while volatility and misleading rhetoric shake out weak hands. This pattern is typical during major monetary transitions, big money, big stakes, and even bigger price swings. Investors who understand historic wealth cycles recognize that physical metal ownership is about patience and conviction. In periods like this, disciplined holders, not emotional traders, stand to benefit most. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Saw that article. It said almost 80% said gold will be a higher share of reserves 5 years from now, all the central banks. And, to me, this isn't gold hype from the World Gold Council. This is the fact that the world is hedging against the dollar system. And I think that is what is happening. When you look at you look at the amount, there was an interesting article I read that talked about energy and infrastructure, where China every year is building onto their energy infrastructure more so than our entire grid, which is 50, 60, 70 years old, whatever, that is in a state of disrepair. The amount of energy you needed to build electricity and to build it that will work for AI and the needs of a globalized or of a country that is digital, that is using AI, that is looking at a system that is broken and in disrepair. If we want to reshore manufacturing, if we want to be competitive, we need to start also by fixing the power supply and upgrading it. There is no way of doing that, but where's the money come from, right? So we're already broken, insolvent. So we're going to print more money. Again, all of the things we're looking at going forward speak to the decline of the value of the U.S. dollar. That's the bottom line as far as I'm concerned. The U.S. dollar is in very, very big trouble ultimately because we don't have enough money to do things like build out the grid, to build out our infrastructure when China is doing that nonstop with their trade surplus. And we're not. And China has the energy advantage and more power and a newer grid, and we don't. And I think we're in a competition that we can't afford to lose by rebuilding the grid, reshoring industry, keeping up with the AI tech costs, involved with all this costs trillions. And where's it going to come from? It's going to come from abandoning the reserve status, as we've talked about, as I've screamed. Now, I might be the only one saying this over and over and over again, that I really believe that we are going to softly default on the reserve status in order to reshore things. And I've gone into that thesis enough. I don't need to go into it again. But I think the bottom line with all of this stuff is stop looking at the noise. At the daily moves. Look at the big picture. The big picture is that the dollar is going to be what is going to be sacrificed in order to compete with the rest of the world, whether it be to reshore, whether it be to rebuild the grid, whether it be to keep up with AI, whether it be to bring back manufacturing. And so gold and silver will be the benefactor of this. And when you see the amount of huge money over the last 8, 16, 17 months that has stood for delivery, that's all you need to see. They're positioning. And they're continuing to do so. And if it's that important important for the governments to do so. They won't make it easy for the rest of us. The volatility, the counterintuitive rhetoric, all of this stuff, that's all part of what they've done forever. And as the stakes get higher, so too will the volatility, and the ability for those to hang on will be less and less and less. Don't let go. Don't sell your metal. It's all I can tell you is that this is not over, not even close. This is the volatility one would expect in a shift like this. And big money, big stakes, big volatility.
Rising central bank demand is reshaping the global monetary landscape. Recent surveys highlighted by the World Gold Council show nearly 80% of central banks expect gold to represent a larger share of reserves within 5 years. This shift reflects growing concern about the long-term stability of the United States dollar amid mounting debt, infrastructure challenges, and intensifying competition with China. As nations invest heavily in energy, AI, and grid modernization, currency debasement risks rise. In this environment, gold and silver stand out as strategic hedges, benefiting from volatility, reserve diversification, and a historic transition in global financial power. Let's get back to the interview.
I think by the CME group which is the COMEX, to knock the speculators off their perch, they raised margins significantly. So normally we'll have 2 or 3 million ounces of silver in our warehouse, and we will hedge it ounce for ounce so that we're market neutral. We'll sell the equivalent of what we have in our warehouse on paper. So one goes up, one goes down. We've talked about this a lot. So you're market neutral with your inventory. If a week or two before Christmas, it was about $16,000 to hedge 5,000 ounce contract, somewhere in that neighborhood. Now it's about $50,000 to hedge a 5,000 ounce contract. And gold is about $40-some thousand to hedge a 100 ounce contract. You have to have that in your margin account. And as long as the market doesn't move against you, it stays there. Well, if you're not a big company with 50 million or more that you can park in a margin account, you're not having a big inventory, first and foremost. The cost of running this business because of things like that has become exponentially higher. With insurance say, well, metals have gone way up, and how are you going to protect that and ensure that within the vault and all, coinciding with the stupid margin increases to the nth degree to knock the speculators up. So you are a refiner. So companies like mine have big enough bankrolls to buy this stuff and stockpile and hang on to it, right, and hedge it. The cost of hedging just went way up. But if you're a mid-sized company or a small-sized company and you don't hedge, you offload it right away. Well, with the volatility we've seen in the market where, $1 moves used to be a lot. Now we're seeing huge moves. You have to be way back of spot if you're not hedging it, because you could take in $100,000 worth of stuff and it moves $10 an ounce and the next day and you're way down. Well, if you're taking large amounts in, you go out of business. So the small, mid-sized companies who aren't hedging, well, they have to be way back of spot because of this environment. Normally, they would give it to the refiner and get spot or, a hair under, whatever, but now the refiners won't take it because the refiners have to hedge theirs. So, if the refiners take in $50 million worth of product, they'll hedge $50 million worth of product on COMEX, right? Market neutral. Well, it takes time to break down the doré, to break down the junk silver, melt it down into pure silver, into shot, and then refine it into bars and rounds, and or the flatware where the knives the blade is stainless steel, the handle is plaster, a little bit of sterling silver around the handle. It takes time to break that down, snap off the blade and break the silver off the handle, and all. It's labor intensive and it takes time. Well, for 2 months, the price of silver was going up so fast and the margin requirements so fast, all the refiners got margin called. And they're like, we can't do this. We take in anymore, we're going to go out of business. We're getting margin called on our short position to offset our inventory, but we can't even melt the stuff down yet. We're getting margin called because of it. The entire industry has been gummed up because of margin increases in particular, and it has reverberated through the entire industry, largely because the refiners, which would provide a great source of liquidity to the industry, aren't anymore. They're not taking any business. And so when you look at the increase in costs on those that use margin and hedge rather, or the risk for those that don't, It's created an environment that no one has ever seen before. Now, I don't think this will last. I just think that this is an environment that it's kind of an outlier. I would not sell junk silver right now. It's the best value, period. Buy it at spot. It is the best value I've ever seen.
Soaring margin hikes by the C Group, which operates COMEX, have disrupted the silver supply chain. Hedging a 5,000-ounce contract now requires dramatically more capital, squeezing refiners and mid-sized dealers. As volatility accelerates, refiners face margin calls before processed metal even reaches market, freezing liquidity across the industry. Smaller firms unable to hedge must discount inventory heavily to manage risk, further distorting pricing. This unprecedented environment has tightened physical supply despite active futures markets. For investors seeking value amid structural strain, junk silver at spot pricing may represent one of the most compelling precious metals opportunities in today's volatile market. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.